All right. What's up, Outliers? Happy Friday. Welcome to another Outlier Options Trading Basics stream where today I want to talk about breaking bad trading habits. Now, there's a couple levels we're going to address this topic from. I have it broken down into fairly stereotypical military level setting. I guess you could say we use these tactical terms: strategic, operational, and then tactical. And it just represents like different areas that people slash different activities are occurring in. So bad habits are part of the game. We're all going to have them. I've had tons of them and I still have tons of them. They're things, it's a constant work cycle. So the way I want to address the topic today is by first talking about this idea of bad habits a little more in detail. And then I want to talk about different types of bad habits that are super common. And if you have a perceived bad habit that you would like us to discuss and work through together, throw it in the chat because I genuinely would like to do that with you. If not, or if you're too self-conscious or you feel weird doing that, to be honest, trading probably isn't going to work super well for you, because you have to be able to hug the cactus. You got to look at something that's a little prickly, not something that you really like, and you have to embrace it. So just food for thought. So bad habits. If I were to rifle off a bunch of different bad habits in trading, they literally all fall under this broad umbrella. Again, in the military world, the strategic level is the highest level of like a planning process. So it's like, think of it like 30,000 foot view, the meta stuff. And at the strategic level, this is even deeper than stuff like not having a plan, not having an edge. It's one level above all of this. And combined top level item is not planning. This is the worst possible habit that you can have as a trader, and we all have it to varying degrees. Hopefully, it's something that you're able to navigate and work your way through over time. But if you are not willing to put in the effort to rigorously plan, this is not going to work. And it's one of the very, very, very first habits you have to attack. So I want to linger on this one for a moment, since it literally is a top driver, and I want to get your thoughts. If you were to explore either from a personal lens, so meaning your own experience, or just general experience that you've come across observing or interacting with other traders, what are the primary drivers of not planning? If you were to try to diagnose what leads people to not plan, what is it? Like, what are the drivers? What's up, Lauren? Good to see you. So Lauren says paper hands and bag holder. I see. Yeah. So that one will bucket down here. Oops, didn't mean to move that. We'll talk about that one here for sure at the tactical level. So we got paper hands and then bag holding. My brain literally was about to spell it holding just because of how much we refer to it that way. I don't know, kind of funny. Joe and Kirk, that's both like that. That is the primary thing, I would argue. I think that's exactly correct. I think the overwhelming driver is that I really do believe this, and it's not supposed to be some sort of like cop out response. I, in my heart, believe that this is the case for people that do not want to plan. I think it comes down to laziness. Because I cannot think of any other positive. I can't think of a positive to not planning in this context. right? So trying to frame the other side, why might somebody not do this? Is there a benefit? And there isn't one here. You gain nothing by not planning. Yet I would argue that the overwhelming majority of instances literally include not planning. And if we flip through, as you guys know, let's go to, instead of options, we do options a lot. Let's go to Theta Gang, just to pick through another one, literally something different. And let's take a look at, I just literally want to scroll through. I don't want to linger on anything. I just want to scroll through it and see what we see. Does this look like somebody that is planning? And then I want to zoom that out to the meta level. So what is your most boring, reliable stock? Don't feel any type of way about that. Crazy method to size up, but the math works. I'm trying to see. Oh, hats off to them. This is planning. This is still a little nuts because they're trying to run 6.25 leverage. But this is planning. So shout out to them. I would give this a feather in that the cap of planning. And I also would have to say, if somebody wanted to try and take out leverage, so they want to take a $50,000 loan at a 15% rate for 60 months, they're actually planning through what that looks like and what they would need to achieve in order for this to be viable. So this is actually good planning. Shout out to them. Are 5% returns per year realistic from selling options? So that's seeking to plan, but definitely not there. Thoughts on holding high beta stock like Hood and selling way out of the money calls over and over? Again, this is the first attempt at a plan, but this is definitely not a plan. Do you guys set buy to close orders at 50%? Same thing. So as I look through this over and over and over again, and thinking of each individual post as an individual data point, right? This is one person. The overwhelming majority of these represent people that have interacted with the market in some way, meaning they're actively trading to a degree, and they have not completed this planning process before they're doing the rest of this stuff. And it really sets them up, as you probably would guess, for failure. So enough belaboring that point on planning. The reason why I'm doing a root cause analysis on why somebody might not do it is because the idea is to try to help people find ways to overcome the root cause. And again, I do believe that this is probably one of the primary root causes, which is laziness. How would I suggest somebody to overcome laziness with respect to planning? I would show them a compound growth calculator. And I would walk them through this exact scenario. If we look at compound interest calculator, let's say that we're starting with $5,000. We're going to save $1,500 a month on average over a long-term time frame. Let's say we do this for 20 years. And let's say that we use a general static market return 10% a year on average. And at the end of the 20 years, that gets you to $1 million. Solid. That's looking awesome. Now, if we include a 2% rate of return variance, and we look at the difference in terminal value, where you returned either 10% on average or 12% on average. And if I look at the difference in these amounts, we go from 1.064 million to 1.345 million. So you increase essentially by 30% by getting 2% variance over the base market return. So this isn't even like an extraordinary return. This is slightly outperforming the market. My point here is that if you were going to take on the mantle of trading, and that's what you decide to do, which is rad. If you choose to do that, awesome. If you choose to do it, this is what you're pursuing. Not necessarily this exact configuration, obviously, but you're looking to incrementally increase your return over a benchmark, the benchmark being the market. So in this context, a 2% outperformance on average for 20 years gives you a 30% total increase in your returns. And again, that's just 2% over a fairly modest market average of 10%. I say modest because really in the last 30 years, it's skewed a lot to the upside. Longer term time frames, 10% is actually a little high, it'd be closer to 8%. So if this doesn't appeal to you, then there's probably not a big cure for your laziness. And to be honest, like, I don't care. My job in what I do for our community and the trading community largely, not to convince people to do this. It's actually the opposite. I spend most of my time convincing people probably not to do this. And it's because in order to do this and to do it well, you have to fully commit. Like, you have to do it. You have to go all in. The partial in thing does not work well for trading. So this is what I would show somebody. And then I would show them one click up, and instead of stock market averaging 10%, instead you're able to average closer to what I've been able to. Well, this is even lower than that, but let's say that you're doing 15%. Well, if you do 15% on average, that puts you effectively double what you would have been at the market return. So instead of 10%, if you return 15% on average for this time frame, then you literally double the performance. You'll have essentially $2 million. Now, this is sans fees, taxes, all that stuff, so it would be less for sure. But the point, I think, hopefully, is at least connecting that, in my opinion, the cure to laziness is to think about what could you do or what would you want to do with $2 million. The beautiful part about markets is that if we have this $2 million, you position yourself to be able to live a pretty decent life without ever having to work again, ever. And you can do it fairly conservatively. I say fairly conservatively because there is the reality of upcoming expenses and, life taking unknown turns and whatnot. But the cool part about that amount of money is, even if you use like the safe withdrawal rate of like 3%, or you use something like that, you have a decent life without ever doing anything ever again. Now, again, if you can position yourself and continue to trade, it gives you a much better planning factor, because the safe withdrawal rate is essentially based on a split between stocks and bonds, just as inflation. Fortunately, that's kind of baked into this, because as inflation is going, depending on if it's driving cost of stuff up, yields also go up. So it's a bit of a net circumstance. Overall, inflation still hurts net negative generally, but it's not like just pure drag. There are elements of strength provided from it. And something like the safe withdrawal rate, those studies, I'm blanking on the name of the study. It's like the something Trinity. So the Trinity study uses different safe withdrawal rates. There's an updated one, but it puts you in stocks and bonds, which naturally counteracts some of those impacts of inflation. So all of that gives you a decent starting point, and that gives you a point where you could do the thing and then stop doing the thing and then go live a life. Now, again, the cool part is if you actively trade, you can guide that up a little bit better, and you don't actually have to just straight up withdraw 3% of the portfolio. You could attempt to continue to trade, guide your trading target down massively, go from that 15% target return to 5%, which is genuinely quite easy to do. And now all of a sudden you have a much better runway, and you can make a lot more money in conjunction with the Trinity study and basing it on still some element of a safe withdrawal rate. This is the why. This is why we trade. The whole point behind trading is to make money, to do things, to live your life in the way that you want to live your life. So if that is too esoteric or something that doesn't connect with you, okay, that's okay. But that person is unfortunately likely going to be a wage slave. And companies are really good at this. I told you guys this openly. I've worked at Deloitte for a few years in management consulting, looking at this exact kind of stuff. And a big thing that companies do is they are really, really good at striking the balance between how much you get and making sure you get just enough so that the friction of moving is outweighed by what you get. So that leads you to be at a point where you'll never fully be able to escape things and live probably the lifestyle that you would prefer to live. So it's going to be, again, it's just enough. So it'll grow. You'll be able to retire in 20, 30 years, but that's a long fucking time. And that was never my aspiration. I absolutely wanted to have financial independence earlier than that. Again, the whole point of financial independence is not to never work again. I probably work more in this context, but it's control over your time. You get to work on the shit that you want to work on, the stuff that you actually care about. So all of this is what gives the why behind planning. Why you must plan, even though this is probably the defining bad habit of options traders. I think the point's been made. Any questions on this one, though? Any points that you would like to add to the conversation? Or is there anything about this that you want to explore a little bit further? Because after this, I want to go to the operational level. And that's going to be discussing misunderstanding options. This is the next terrible habit. And it becomes accepted to do this. And we'll talk about that. Ben says, I was surprised at how low Deloitte paid considering their reputation. Well, it also depends on like what your pedigree is, right? Because I mean, for let's say an MBA hire, you actually come out pretty good. You start in the high ones. So I'm not sure what you were looking at, Ben, but like in their tax side, they're not really killing it. But in the consultancy side, especially people that come from target schools with MBAs, they're paid really well. They'll make more than an investment banker in the beginning. IB typically will outpace longer run, depending on what the partner track looks like. But I mean, it's definitely commensurate. So yeah, I'm not sure what you were looking at, but they get paid a ton. Now, and again, that's like high ones right out of college, right out of an MBA program. So not many places will get you there. Then when you get into the partner track, it's kind of completely different. In the partner track, you get into sales. So you can make a ton of money as a partner because essentially you're booking really, really large business and you get pieces of it as it's brought in, eating partial what you kill. So yeah, you make a ton in consulting. Reese says, I've never known what a consultant actually does. It's kind of frowned upon in a lot of ways just because it's seen as like people who don't add value. But obviously the reason why they get paid so much is because they add a ton of value. The way to think about it's if you have a good consultant. If you have a good consultant in a good consultancy, you add massive value. So Reese, the way to think about consultancy is it's kind of like a targeted team to do something for a business. So what that means is, let's say that you're Palantir and you're looking to expand a business line from government to commercial. You can hire consultants to come look at that problem set with you and to build an entire roadmap on how to do it. And they leverage a lot of industry expertise because consultants get plugged into different industries and then they build eminence within those industries. So there's a lot of legacy information that also provides a lot of value from consultancies. It's kind of like experience that you can tap into. So that's kind of like a strategy side. Then there's a operations implementation side, where let's say that you finish the strategy project and you have a good game plan. Well, then you can onboard new consultants, extend the engagement, whatever, to then implement. So then to help build the talk track for sales, to help build pitch decks, to help manage pitching and external clients, all that kind of stuff. So it's kind of like a corporate special forces team that can come help with like a very specific problem set. Typically speaking, it expands over time. But yeah, they high tier consultancies, they actually make a ton of money because of the amount of value that they can drive in a really short-term time frame. Now, again, consultancies can also get a really bad rep because sometimes they literally don't do much, and they can be expensive, but that's way more the exception than the rule. You don't become, Deloitte, KPMG, EY. You don't become those kinds of places with the consultancies at the rates that they do by doing a bad job. It's just the reality of it. It's typically very, very thorough, and does a lot for the places that we worked at. So yeah, consulting's really interesting. I enjoyed it a lot. It was like the best post-Marine Corps step I could have considered, because you get to learn a lot really, really fast, and you're around a lot of really smart people. And that was a great stepping stone, because I did finish my MBA while I was on active duty. That all flowed really well. So that's the planning side. Let's talk about misunderstanding options, because this is absolutely the next, I would literally call it an unforgivable habit. Like, this isn't a choice. If you choose to trade options, you don't get the choice of, do I want to learn about them, or do I want to learn the nuances of them or not? I mean, I guess you technically do get the choice, but there's only one answer. You have to learn them. You have to learn your tools inside and out. It's the only way that this is going to work. And the nuance about trading options is there's a lot of fucking nuance. So it takes time, but this becomes a conscious effort. And it has to be sustained. Think of any other career field where you learn a skill. A lot of times there's like continuing education or continuing certifications and requirements. That's for a reason. It's to build your proficiency, but then also to sustain your existing proficiency. Options are the same. If somebody is looking to trade and they want to apply the Pareto principle, meaning maximize your output based on the minimal input that you can, logically provide, the 80-20 rule, that's dollar cost averaging into an index ETF and maybe trading some individual stocks that you like. That's the Pareto principle. So as soon as you decide that you want to do more than that, going half-assed doesn't work. There's not like a half-assed successful Pareto principle beyond that. And a common thing people will say is, well, what about like selling calls against stock that I own? That systematically underperforms just holding the stock. Same thing with selling puts to acquire stock that you want to own. That systematically underperforms buying the stock. And it's for a reason. Both of those strategies decrease your volatility. There's an absolute benefit to those strategies, but that's baked into the risk reward profiles of them. So when we're talking about understanding options and overcoming this, my recommendation here is really, really simple. Set a cadence and don't stop. So for example, you could grab a copy of Options as a Strategic Investment. You all know I like that book a lot. Grab a copy of Options as a Strategic Investment, read a page a day, period. You miss 0 days. read at least 1 page a day. And again, if you're reading that and you're like, damn, like I don't like doing this, this is a lot of work, that's okay. Because now you still have learned a valuable input. The input being trading is not for you. And you should go apply the Pareto principle, dollar cost average, into an index ETF. You will be light years better off. There's not an easy button here. It's just doing the work. Now, the beautiful part about options is that although they can seem highly complicated, over time, they're really not that fucking hard. It's really not that difficult. You're not solving some new frontier that's never been looked at. You're trading things that have literally been around since BC era. So it's learnable, but it does require that effort. And you have to, define what effort you're willing to put into things. That's completely the trader's decision themselves. So my biggest recommendation here is to start and don't stop. Just begin the process and continue. So there's some really easy ways to do this. And I want to talk about some of these specifically, the misunderstanding options, because I think that this is a great discussion point. I'm going to go back. I think I closed it already, but I'm going to find that Theta Gang community again really fast. And I want to talk about it with you guys. I want to talk about some clear instances where you can see that somebody doesn't understand options, because it is absolutely here. We can see it. So let's flip through. Let's see what we find. What is your most boring, reliable stock? I'm looking to add a bit of stability to my rotation plan and start selling credit spreads on Costco. Not very volatile, but the premiums at scale are nice to make a consistent income. Does anyone else do this or have a boring, relatively flat stock they use? This is misunderstanding options. Why is this? Who can tell me why this person is misunderstanding options? Why do I say that? Why do I say that they're misunderstanding options? They are. Why? I want you to focus on not all that. That's a bunch of noise. I want you to focus on this. And I want you to focus on this. Jordan says credit spreads statistically lose money over time. Not necessarily. I wouldn't say that. Ben says they want to sell vol but want low vol. I wouldn't say that either. That's a good guess, but I wouldn't say that either. Reese says you'll get paid a boring amount for a boring stock, IV dependent. That's part of it, but they're not necessarily saying that they want to make a bunch of money. So I wouldn't say that either, to be honest. This is looking at the problem wrong. What did I highlight for you guys here? This is completely mistaking the trading process. I give you guys a really common / referred framework for this. What are they doing when they say, I want to look for a reliable stock? Or I think I'm going to start with Costco. Bingo, G36 is on it. It's looking at the equation the entirely wrong fucking way. They're literally down here in this process. They're already on this page and they're already trying to build and execute a trade. And they've already decided what ticker they think is going to do what they want to do. So what are they missing? They're missing all of this. This is a prime example of not understanding options. They can sell credit spreads, and credit spreads, technically speaking, can be completely viable long term. We can build a strategy where you trade credit spreads that make money. It's not going to make as much money typically as buy and hold, depending on your timing and all that kind of stuff. But it can be done and it can be profitable. So like that element for income, that's possible. Again, depending on the way that they think about income and whatnot, you guys know a lot of the nuance there. So the problem here is that they're just talking about a option structure, vertical spreads, credit spreads in this case, and they're talking about a ticker, Costco. That doesn't even fucking mean anything. They do not have a profit mechanism defined. They're just picking random names. So if we take a look at the ticker that they're talking about, there might be something there. Let's see. If we take a look at Costco, there is something there, right? If they choose to trade put credit spreads, for example, they're capitalizing on the standard trend of the stock price direction. The trend is it goes up. That's one profit mechanism. If you're selling put credit spreads, it's a bullish play. However, understanding that profit mechanism is really, really important, because if I'm trading short puts in something that tends to go up and I'm trying to track that price direction component, maybe I need to be a little more aggressive with how I choose to roll my short puts to maintain exposure. Let's take a look at an example in Costco really quick. Let's go to here, 9 April. We'll go from 9 April to 3 June. And let's look at an example. That's hilarious that this literally automatically went to 9 April. That is complete happenstance. Pretty funny though. And I want you to pay attention to the way that these strategies or these different positions behave. So let's do the 16 May. What's another profit mechanism, by the way? I kind of cut myself off because there's another profit mechanism here, by the way. What is it? If we're selling put credit spreads in Costco, who can tell me? Somebody should know while I'm inputting this trade. 16 May. Kirk says theta, sort of. Reese says short vol. Yep. So short vol is another target. What can you guys tell me about the pricing of short puts in large names? What can you tell me there? And let's take a look at the vertical. VRP, not inherently VRP in this case. It might have risk premiums, but that's not it. What other guesses do we have? The next hint is, how does put premium typically compare to call premium? That's your next hint. And let's take a look at this vertical spread. Let's do like short the 865s, long the 860s. Put skew. There you go, Jordan. That's exactly it. That's another profit mechanism that exists here. So names like Costco typically exhibit put skew. And it's because of structural artifacts. Most people that hold stuff like Costco are going to be institutions, pension funds, really big funds. So a lot of times they like to hedge their position via long puts. There's a risk premia associated with that. That's different than the variance risk premia. There's an equity risk premia. And this is a component of that. It manifests in different ways. Variance risk premium is just the difference between implied and realized vol. And in this case, implied and realized vol obviously is still part of this equation. But there's also put skew, which is stemming from the equity risk premia factor. So the point I'm making here is that there's a lot of different profit mechanisms that a trader could choose to attack in this thing. But without understanding what they are and building something for them, you essentially forego all of the specific nuanced details that would lead to a better position. So let's take a look at the example. I'm just gonna move this right here for now. So we're gonna be at the 860 for the long puts. That's a 30 delta. And then the short put is gonna be the 865. And that's 32 delta. That gives us $1.15 in premium. And then let me grab my little, calculator. Here. And this will be a one lot, 5 points wide, collecting 115, risk 385. So here's our trade. And let's do two versions of this trade. One version is what we just made. And then the next version, we will start with the same trade, but we're gonna behave differently with it. So I'm gonna fast forward to the end of the week. And at the end of each week, for the second variant, we're gonna adjust the trade. It's not gonna be static. Now, we cherry picked a period where we know it generally goes up. So this is going to prove a specific point. The cliff notes, though, is that this doesn't hurt you if it goes down compared to the other trade either. And I'll show you why. So let's see what we're at now. So the 865s and the 860s are now for 82 cents. So we're going to close those. It's 11 April. The stock is now at 950, 951. We're going to close these for 82 cents. Okay. And then we're going to open up a new one. So this will be 11 April, same ticker. Stock is at 951. We're going to keep the one lot. We're going to stay in 16 May. And we're just going to rebalance our trade. We want to be around a 30 delta short. So that gives us the 905s and the 9s. The 900s are 30 delta. The 905s are a 31 delta. Premium's $1.30. So this is what we have for our trade. Risk is 370. Cool. So we fast forward the next trading week. And I'm not going to go all the way to expiration. We'll stop in the middle. Maybe we'll do one more. But do you see what's happening right now and how this ties back to tying the profit mechanism and understanding what you're trading? Because, well, you'll see in a second. So now our 905s and 9s, we're going to close those for probably, what's the spread here? 927. It's these that are excessively wide. So we'll probably close these for something towards the midpoint here. Not like this mid, but I would guess like 65 cents or 70 cents. We'll call it 70 cents. And 17 April. We're now at 985. And we're going to close these for 70 cents. And then we're going to open up one more. Same expiration. Actually, we'll move these out. This is liquid enough. It's not, so we'll stay in the same. We'll stay in the monthlies. And we'll compare what's going on here. So 19 April, Costco again. We're going to be at 985. Spot price 1. We're going to stay in 16 May. I would look to move them out personally, but it's just not liquid. And then we have a 31, and the long options will be the 945s. Those will be for 29 deltas. The 950s will be our shorts at 31 deltas. We're going to get $1.45. So we're risking 355 now. So what's the net position here? What's happened? If we understand the profit mechanism in this example is the direction. We think Costco is going to go up, so we want to sell puts in, well, put credit spreads, because we want to trade it directionally up, but we also want to capture some of the put skew. So we choose to do it with short options. We buy the option maybe because we have a small account. We can't handle if it rolls down a lot, whatever. So at the end of this, let's say that this goes to expiration. And let's just say that we were able to close both of them for a full win. Let's say that they just expire. What's the difference in total profitability between these two scenarios? This scenario, you would have made 238. This scenario, you made 115 bucks. This is why understanding options is so freaking important, because for the same idea, you can literally make 2 times the money if you build something that's relevant and then you manage it in accordance with whatever the profit mechanism is, understanding the way options behave. Because what I know is that as Costco goes up, you're going to lose deltas. As you lose deltas, you lose what you make from those directional moves. And again, for something that's really, really close like this, your directional exposure is still muted because we only did stuff that's 5 points wide, but it's still there. So not only do you start losing deltas, what happens to your theta and the theta decay in the rest of the position? Who can tell me? So for the 9 April, it slows down. That's exactly right. Reese has it on the nose. It slows down tremendously because you have less of it. So if we go back really quick to the onset of the experiment to 9 April, and let's take a look at the theta for the 865, 860s once this loads. We'll compare the net thetas between the two scenarios. So your theta here is short 59, long 59. So you're about flat on theta. You're making like 1/10, something like that. So let's fast forward to where we were. And let's see what the 865s and 860s are at then. So it's now essentially about a penny, or I would say, yeah, it's about a penny. So your net theta would have increased on a per day basis. The remaining theta, so what you stand left to make in the trade, will have gone down massively. And again, this is just because we're trading really narrow spreads. If you widen them out, the effect would be slightly different. So if they choose to trade Costco, and let's say that profit mechanism is part of their plan and part of what they're doing, they'll want to adjust the way that they're trading so that it's logical. If, let's say, direction isn't part of what they're trading, then the management still matters, because at least for me, there still would be a rebalancing component. Rather than staying in 16 May expiration, though, I might look to continually rebalance short at the 30s, long whatever the wing is. But I would rebalance it periodically, maybe based on delta bands. And then I would look to maintain a certain exposure to a certain expiration, meaning days to expiration. But that's based on the profit mechanism and then building something that's relevant to that profit mechanism. So the last thing that I want to hit with respect to this quickly before we kind of open it up a little bit more. I don't even know where we're looking for a green triangle. There it is. Is from the operational lens, there's obviously the element of building stuff that makes sense. That's the planning phase. But then using the tools to maximize the capture of the effect. And I think that's probably the next absolute most profound poor habit that most options traders have, is they don't do that. They start the process from what indicator settings should they use. This person is starting the process from what stock should I pick. The stock doesn't matter, right? The profit mechanism matters. The effect matters. So if you're looking to trade something with put skew, why would you ever relegate yourself to just Costco? Maybe you define what volatility should be, not just in terms of implied volatility percentile, but also how much the thing moves. Maybe it's an implied volatility view compared to average true range for duration, whatever you pick. But this is a clear display of misunderstanding options, because this doesn't make sense. Okay. I think that point has been hammered pretty down. Now, I want to talk about some of the specific bad habits that you guys feel you have, or just habits that you might want to work on. And one of them before was from one of our crowd favorites. And I want to talk about it. So this is going to be a 2-scale drawing. And so this is, again, everybody in the chat will know who this is. And this person has 2 primary issues that they're looking to address. One of them is paper handing. So in this side, we have a brown paper bag. And then I actually forgot what the other one was. I think it was bag holder or paper hands. Oh, I see. So this one would be taking the trade off too fast. And then this one will be, does anybody know what that is? It actually looks like a fucking squirrel, doesn't it? That's not what I meant to draw at all. But I think that that looks like a squirrel, which is fucking hilarious to me. Not supposed to be. But that's supposed to be an origami figure to represent paper hands and then bag holding. So these need to switch. Good old bag holding. So let's talk about these habits. Why do they exist? If you guys were to help your friend, Lauren, let's address these one by one. So Reese is highlighting loss aversion. And this one would be for bag holding. Okay. So how do we address loss aversion? And then Reese says disposition effect. I was literally going to say that's really the overarching thing here. Is the disposition effect. For those that might be new to the concept or might be, watching the stream recording, the disposition effect is really, really well studied. And it's the propensity for traders to hold losing trades while cutting winning trades too fast. So there's a lot of emotional drivers as to why that's the case. None of them really matter. What matters is, how do we fix this? What's the way to fix this? Anybody know? Fortunately, it really is pretty easy. FXD says pick exit thresholds before setting the trade. That's part of it. Definitely part of it. So let's, for FX, let's follow this thread. So let's say that I'm a trader and I have a propensity to either hold losing trades or I have paper hands. So your recommendation is to set exit points, which is great. That's exactly where we need to start. So then how do we do this? How do I pick exit points that would allow me to adhere to them? Because what doesn't work is picking random obscure exit points. That's not going to get you any closer. So then how do we solve for that? How do we pick these exit points? You guys will notice that this shit all connects. The same stuff over and over and over again. FXD says acceptable losses based on larger portfolio strategy. Close. I wouldn't say that. Let's use a more specific example, the Costco. When I said if they're looking to trade the directional profit mechanism with a mix of some put skew, and then I arrived at rebalancing deltas. How do I get here? By understanding the profit mechanism. And then building a strategy that reflects it. So the way that I set logical exit points is not by putting on a trade and saying, I think Lauren likes to trade SoFi. So it's not going into SoFi and saying, I'm going to get out if SoFi goes to 2021 or if it goes to 23. That's not it. Ben says you just have to stop it. That doesn't really work that way. Ben says those two problems seem to assume they already know they are doing it, which is why I say they just have to stop it. It doesn't work that way, though, right? The reason why it doesn't work that way is then what's the alternative? Do you just not close, right? Like if we say just stop it, that doesn't actually mean anything in the context of this. The way that we technically would, quote unquote, just stop it is wrapped into some version of this, right? Because these are the antithesis of one another. So the way, like, there has to be a logical approach to figure out how to stop it. And the logical approach is literally what I'm showing you now. The outlier strategy process. I literally already gave you guys a 4-step method to do all of this. The reason why this is so important is because based on the profit mechanism that we're looking to trade. So let's say we're going to trade SoFi and we're going to trade price direction up. And let's say that we are trading stuff that's smaller, more volatile, tends to have higher average daily ranges and average true ranges, right? If I take the time to study stocks like this, I'll have a better understanding of how they move. And then I can logically determine based on a data set where would make the most sense based on the profit mechanism itself for me to manage the trade. So for example, if we run this via an eyeball test, I'm actually going to get Trading View because I think the tool for Trading View is a little bit better for this. And let's go to SoFi. So let's zoom this in to daily time frame. And let's just eyeball stuff super fast. So if I forgot how to fucking use this thing. Where's like the regular drawing? I think it's this one. Yeah. So if we look at different moves that exist here, can you not do multiple? You got to click it each time. That's my bad. What we can do is we can create a profile for what we're trading. We can say, how does this thing tend to behave? So then how can I logically set different points? So for example, I would be using this move as a reference move. This move right here as a reference move is really, really appropriate. Because if we squish this down and we compare these two moves to one another, they're not all that dissimilar. This move would have taken us to new all-time highs. This move is also taking us to new all-time highs. So we can measure the duration. We can measure the severity. Then we can say, well, as this thing starts to oscillate sideways, when's a good point to get out? And again, understanding profit mechanisms. If I use a really, really basic momentum following approach, in this case, we use the 50-day moving average, and I get out if it goes below a 50-day moving average by a certain margin, or if it has consecutive closes below a 50-day moving average. There's different variations, which again, you can test. So I would literally test different methods to follow the momentum of these kinds of stocks. I would download the data and I would first analyze the type of moves that it tends to have. What do breakouts look like in these kinds of names? Again, what's the comparative severity, duration look like? How do I determine when to get out that's logical? Well, again, maybe if I'm applying a trend following approach and I decide to use if there's 2 closes below a 50-day moving average. Okay, so we get in somewhere back here on the initial breakout. We're in it. And then it comes down. This isn't still below 50. This goes below a 50, but it's not a close. 2 consecutive closes. So then it rolls back down. This closes below 50, and then this closes below 50. So then that puts us entering here. And then exiting here, which represents a 90% return. It's not perfect. You didn't top ticket. Obviously, this would have been a better exit, but it's something that might be appropriate and it might be sustainable for the thing that you're trying to trade. The point that I'm making here is the way that you short circuit bag holding and paper handing is definitely through this process of setting exit points. But the way you set exit points is ultimately what matters. Because if you set just arbitrary exit points, it'll never feel good. Because it'll just feel like magic. It'll feel like this is completely random because it is. So that's a really good habit to highlight. And this is exactly how you circumnavigate this habit, is by doing that kind of work, which we can take a deeper look at that if you guys want. But before we do that, I'd like to pause and see if there are other habits that you want to talk about and explore addressing together. It could be a habit that you feel you have or just one that you're curious about. But there's tons of them that I can think of, but I would love to make it more relevant to you guys. So are there any other habits that you want to explore? Over trading, that's a great one. That's a really, really great one, Kirk. So let's talk about over trading. And first, as always, let's begin with a root cause analysis. A great way of running a root cause analysis is through a fishbone diagram. You guys familiar with these? Show you how to do it. So, Kirk, I'm going to use you as the example because you posed the idea. I don't mean that this is for you, but this will be addressed to you and other people can chime in the chat as well. So the first why is, why are we over trading? So Kirk, what's your answer to that? And then anybody else, what would be your answer to that? The first question is, why are we over trading? And then we'll note that down. Wanting quick money. Okay, beautiful. So I see 3 answers. All of them seem highly viable. And for one, we'll list a few of them. So we'll have quick money, boredom, overexcited, revenge trading. Okay. So literally for all of you that responded on this first with these different answers, the next question is, why do you think that this will help you make money quickly? The question for this person is, why does overtrading fix boredom? Why does trading activity assuage being overexcited? Why does overtrading manifest in revenge trading? How does that help revenge trading? So the way to think about this, Kirk says, I see the credit hit my account when I put on the trade, so I assume it's easy money. That's really perceptive. So the next question here for Kirk is credit into account. So then Kirk adds a third layer automatically by saying, assume easy money. So then the next version of this for Kirk specifically is, why do you assume that it's easy money? So we don't have to go through the whole exercise, and some of it can start to feel a little repetitive. But the whole point of a fishbone diagram in this context is to thoroughly explore a root cause. So in this case, we can identify a series of different root causes that all dance around the same thing. We have a misunderstanding of options due to this component here, right? This idea of seeing credit hit an account and then thinking that this is easy money to get at, it shows just a simple misunderstanding of options, which we can address. This idea of quick money is also easily addressable because we can compare a hyperactive trading approach against a less active trading approach like buy and hold. And you might find that buy and hold outperforms the higher active trading approach. So when we think about over trading, starting from the context of what is your root cause is really important, because it's going to be highly, highly different per person. But in this context of quick money, what I would do is I would analyze the different strategies that I trade and I would compare the performance. And if I say that and somebody says, well, I don't have that information to compare, again, we go back to root cause problems. In this context, we go back to that very first item that we touched on. The strategic level of planning means that we haven't planned. We have to go back and address this very first step. We have to have that planning component. So over trading can be really nefarious. I think another really common one, which is partially what Reese mentioned, but to expand on that idea, is it is really, really common for people to think that the more they interact, the better the performance. And there's a lot of research, we literally look at it right now, there's a lot of research that shows us, again, it's a misplaced idea. So I'm going to go to SSRN, and I might try. Well, first, let's see what's here. I'm probably going to use Perplexity. And it's just because Perplexity tends to be good at this kind of stuff. But first, we'll start with just a search on SSRN, a very standard landscape analysis. Always, always, always start with the landscape analysis. And then simultaneously in Perplexity, I'm going to ask it, look for research that explores the relationship between trading activity and profitability. So what I'm doing here is I'm starting, as described, with a landscape analysis. And the point of doing this is because for somebody that feels that the more engaged, the more active, the more they trade, the better the performance will be, well, we can literally fact check it. So let's see what we can learn. So as you can see, we can literally look for actual research that explores the topic for us. There's a Amazon dude at my house. People are more willing to bet on their own judgments, feel skillful or knowledgeable, investigate whether the competence effect influences trading frequency and home bias. Investors who feel competent trade more often and have more internationally diversified portfolio and blah, 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 blah. So this just gives you a beginning contextual understanding. This is from the University of Cape Town. This is hypothesizing. Oh, here we go. So this is actually in the Global Finance Journal. So we'll grab root cause, root source, a key. And it says research has shown that investors trade too frequently. Overtrading lowers investment return. And this paper essentially analyzes it. So all I'm showing you is that somebody that has or thinks that they're overtrading, you can research the impact of overtrading. And you can see that the typical research shows that it's a net negative impact. It's generally bad. And it's not only because you incur costs, but you add friction to your own system. So when trying to rationalize this kind of stuff and trying to figure out different ways to address the urge to overtrade, we start with a landscape analysis. We find that overtrading negatively impacts us. So that begins at the base. So then the follow-on question is, okay, well, how much should I trade? And again, the hilarity of this is that there isn't an amount of trading that makes sense or doesn't make sense. Because what does it matter? Like, what does it amount to? The profit mechanism. If you take the time to research a profit mechanism, you quantify it, you understand how to monetize it, then that's going to dictate to you your trading frequency. And it inherently will be more logical than simply saying, I'm going to trade three times a day or 50 times a day or whatever the number is that you arbitrarily set for yourself. So in my opinion, the way that we address something like overtrading is, again, going back to that planning stage by outlining the profit mechanism that you're attempting to capture and by aligning the strategy with it. I don't purposefully take it all back over and over again to this idea of profit mechanisms, but in effect, that is what this boils down to, genuinely speaking. Because if you do that, you naturally address a litany of common poor habits, literally, by starting with the research segment of the process. So that's enough pontificating, I think. I'd like to pivot now a little bit, and I would like to see out of this list of stuff, so these different kinds of trading habits, is there one of these habits that you want to double click into and talk about different methods to fix? Because that's what I would like to do. I'd like to turn this into a little more of a prac app style conversation. And in the meantime, your boy's getting his dinner order ready, because your boy needs that din-din. So out of these different habits, are there any that really stick with you, that are difficult to overcome? And then I want to actually work through it versus this theoretical framework, but I want to click in from a more practical application approach. Surprise Texture says, hello, Eric. Do you feel nummy about GME boning Fractal next week? Probably tomorrow, I think, personally, but we'll see. So let's take a quick look then at the last version of this whole process of breaking bad trading habits. And it all boils down to essentially the planning process. And again, that's the outlier strategy process and the outlier trade process. So let's talk about, though, how that addresses essentially all of these habits. And it's literally something you can start today. This is not like fucking magic that I'm talking about. This is just the work side of trading that you need to do. So let's use the original example of overtrading. And let's say that we want to address the overtrading by trying to find what the correct amount is, okay? So let's start with a hypothesis. Let's say that the profit mechanism that we're going to trade is, again, this price direction stuff. And we want to try to strike a balance between letting things move and not getting completely ran over if things go against us. Again, the Pareto principle, the easy solution here is buy and hold. If you buy and hold, you go through P&L volatility, but then you get the ultimate move in the thing that you think is going to move. So then the next way to think about this is, okay, why wouldn't I buy and hold, right? The planning process here for me typically starts with trying to use known and defined market effects and then iterating off of those known and defined market effects. It's a much easier way to start trading than just randomly make everything up. So in this example, The market effect is the expectation that SoFi is going to go up. That can be based on our fundamental analysis, technical analysis, whatever it is. So then the base case is buy and hold. So then the next question is, okay, how do we make buy and hold a little bit better? What's wrong with buy and hold? In this context, we might say that it's capital intensive. We might say that we don't like having the portfolio volatility of buy and hold when we want to be able to size this trade up a lot. And it's difficult to size something up a lot. Let's say that you got in here when it was 12 and it rallies all the way up to 18 and then it comes all the way back down to 8 and then it's all the way back up, right? Let's say you don't want to go through that process. So then how can we address that? Again, it's actually really, really easy. The way that we address this is by starting with the broad plan, identifying the gaps, and then figuring out specific solutions to those gaps. So if we don't like the P&L volatility, what could we do? What do you guys think we could do to mitigate some of the P&L volatility that you see here? Let's just say that we look at it and we think that this is just too volatile. What could we do to address this issue? What guesses do you guys have? Super simple. Recess stops. Okay. That's one way. What else? What other ways could we address this problem? Sell puts reduces volatility of buy and hold. Kind of. But if you sell puts, it can also, again, depending on how you're calculating the volatility, it can increase it because you're capping the profit potential, but then you're still accepting all of the downside risk. So it can, in a way, depending on how you look at it. Mikhail has the most important component is size. Okay. What else? Find lower ADR stocks, aim for smaller returns, do spreads. Well, let's say that we like SoFi and we actually like the overall movement patterns, meaning how much it moves, because it gives us a lot of profit potential. Good example is going from 7 and change up to 18, right? Like that's a huge move. So you're slightly tapping on the broader element here though, which is analyzing the behavior of the thing. So let's use this again as a practical exercise. If we like the potential for us to make 135% over what is that, like 4-ish months? Yeah, 80 bars. So 80 trading days, 115 calendar days. So if we like the potential for this kind of move, well, let's start by analyzing how this thing behaves that gives us these moves. So I'm literally going to do that now with you guys. What I'm going to do is go to bar chart first, and I'm going to download SoFi. I'm literally just going to get historical data for it. So I'm going to give it to me in daily candles. I'm going to have it go back essentially to 2000. So now I have the data. So I'll pop that open so you guys can see it here. And I can either analyze this directly in Excel if I want. I can have it plot the percent changes over day. I can have it do percent changes in between days over 5-day periods. There's a million different ways we could build out the analysis in Excel if we want. Instead, I'm literally just going to upload it into, what do you guys think? Gemini? Want to use some Gemini? And I'm going to upload it to Gemini. So then the next step for me is essentially tell Gemini what I want it to do. I want it to conduct a statistical analysis of SoFi. Create plots that show the distribution of daily, weekly, monthly, and quarterly returns. I want to analyze local high to trough drawdowns, understanding their frequency, severity, and duration. Let's start here. There's a bunch of other stuff that we're going to want to do, but we're not quite here yet. Lauren says this feels like a different SoFi though. At all-time highs, does that matter? It matters if you can quantify the feelings. But the other reality is SoFi spends most of its time, just like most growing stocks, will spend most of its time near all-time highs. Just a function of something that's growing. So it would be really important to be able to like directly quantify, because otherwise it is just like a random feel, which ultimately doesn't matter. Random feel doesn't matter at all. Because if we take a look and we pretend that the right part of the chart isn't here, that's all-time highs. That's all-time highs. That's, well, I guess term highs. What's the actual highest this thing has ever been? No, it's all-time highs. I guess not. That's a lie. So it was 20, I think this is like post IPO, like the 23 handle. So we'll call those all-time highs, but we'll call these term highs. So that's local term highs, right? So the point that I'm making is that the thing itself is going to spend most of its time in these ranges. And that's the nature, again, of stuff that's growing. Let's see what Gemini shows us. So this is showing us stuff that doesn't make sense. This looks correct. These don't look correct to me. And it's mostly just the way that the plot is broken out in terms of days, which is bad. Take a look at these drawdowns. These look correct. So this is a really helpful plot, isn't it? Because if we take a look at the distribution of returns, and then if we take a look at even this plot to understand what the drawdowns look like over different durations, we can get a sense of how much this thing tends to go down on average. What's the most common drawdown level that it hits? And then the distribution of those, which is actually quite useful. So then the next thing I'm going to ask it to do is I'm trying to understand what this thing is. Has the maximum drawdown. And then this is obviously using from the inception to now, which is fine. So what we needed to do is to exonerate the duration and severity off of, we need to get rid of the starting point because that's skewing everything. So I'm going to ask it to plot all again, removing the 2021 to 02-02 data point to remove the skew. So the output of this is we should be able to say, on average, this is how much SoFi goes down. When SoFi goes down beyond this, as a percentage of time, it tends to go down this amount over this amount of time. And we use all of that to go back into building a position that makes sense for what we think in SoFi. Now, this is highly specific to SoFi, but the process applies to any individual stock that somebody takes a particular interest in. And this also applies to this class of stocks, these kinds of stocks that tend to behave somewhat similarly. So let's see what this comes up with. And then kept it in, which is kind of annoying. So what I'm going to do is change this plot. I'm going to ask it, it kept the, I'm actually curious what it's going to say. Why did you, oh, because it just used the next date. That's logical. I understand why it did that. That was a poor prompt by me. So let's do plot again using drawdowns that are less than 200 days. All it's doing is essentially moving the data point one day to the right, which I understand that was a bad prompt by me. So anyways, while this is doing this, going back to this, if we just eyeball this as well, there's some very clear trends, again, that we can see. We can see that the stock goes up. At some point, it starts to consolidate. The way that it consolidates looks slightly differently. In that period of consolidation, there's a couple things that stick out to me. I noticed that the moving averages all kind of converge onto one another. The short term flattens out, and then they all start to slowly flatten out as we go through this consolidation phase for longer durations. And then every single time before it starts to roll over, there's a couple things I can determine. One of them is the relationship between the different moving averages. The reason why I'm verbalizing all this is because it all feeds into how we might determine how we want to hold this thing. So while we're waiting for Gemini to summarize everything so far, if I were to do this myself, I would essentially apply a breakout style approach for these shorter term surges. And then I would apply a momentum style approach for the remainder. So how do I pick a momentum style approach? I go further out in time and I just buy options. I essentially trade it as buy and hold that's leveraged. Trade a ratio called diagonal. That's literally what I'm doing right now in SoFi. Then how do I choose when to exit? Well, I start with stops. And when I first entered, I'll set a stop, let's just say, for example, here, below this initial consolidation. Then after this gap up, there's a new stop that goes in here. And the way to do this is really, really dependent on how you build your trade. You can either have binary stops where if it hits your stop, you just get out entirely. You can have stops where as it starts to trickle down, you get phased out of your position. Or you can naturally phase out a part of your position as it's going up and then place residual stops. So the way that you figure out which of those you want to do, you have to test. And you can test in something just like this. So we can see what the actual max drawdowns tend to be. So in this case, this represents a 20% drawdown. We can see what the average durations are, and we can see the frequency. So because of this, we can say, well, if we get a 5% drawdown, those happen all the time. So if I get out on a 5% drawdown, I'm going to get kicked out way too early. but there's a slightly larger cohort of 20% drawdowns. So the first logical thing that I think about is as we get outside of this 5% drawdown window, there's a pretty high frequency that we're going to hit 20% drawdown subsequently. So as we get outside of a 5% drawdown, maybe give it some room, go to 7% or something like that. But if it goes beyond that, there's a pretty high frequency that it's going to move down the residual, in this case, 20%. So then I would want to get out before that. That's where I would choose my downside exit point. Then for the upside exit point, it depends on where I think the stock is going to go long term. I might not have one. I might say, well, I think it's generally going to go up over the next year, so I just want to hold it. I want to maintain the exposure where it's going to go up. Where is it going to go up to? Don't know. Well, we can come up with some guesses. We can see that this move here was 140%. So what we can do is we can take a couple of these prior sample moves and then we can plot that out. So for example, to do that here, this was a 140% move. So if I want to know like what the potential is for it to go further, I'll plot from here another 140% move and see what price level that takes me to. Now, again, the percentage of the moves is going to decline as this thing grows and gets more expensive, but it gives you at least a planning factor. So you have some sort of idea on what this might look like. Lauren says, I stopped out of some calls to almost pay for the entire trade, including runners. Is that plan bad? Stopped out of some calls to almost pay for the entire trade. Yeah, it doesn't make a lot of sense because you're basing the exit on the cost of the trade of the runners, right? Like that's not a profit mechanism. So it's a common misconception because it's like the idea of like playing with house money. That doesn't mean anything. It's all your money, right? People do that when they're in profit like this. They'll say like, oh, well, I'm, in the black, I'm playing with house money, but you could realize the gain right there and take the fucking money. That's still your money. So in your context, Lauren, I would say it is a bad plan because you're basing it on an arbitrary external effect beyond the profit mechanism. And you're saying, well, I'm just using it to pay off the runners, which now I'm sure you're viewing as a risk-free trade that's remaining. But again, it's not, because there's an opportunity cost to that money. And the idea is to trade the profit mechanism, not trade the cost of positions. So really, really common. A lot of people do that, but totally understand where your head's at with it. But yeah, I definitely would avoid doing that. And I would focus on the profit mechanism. All right, gang. I actually just realized that this has been an hour and 40 minutes, way longer than I expected. But that also shows time flies when you're having some fun. So tomorrow we will have the GameStop live stream specifically for GameStop to get caught up. We didn't get a chance to get through GameStop last week. We were kind of analyzing the broader meme stock landscape. Then we have the Outlier Pro market prep stream. We're going to scan for the week ahead. We're going to go through a bunch of earnings plays, essentially looking for opportunities. And then we have the next Outlier Pro Plus Zoom workshop that will be on 21 July. So that's where members will link up with me directly and we'll connect as a group on Zoom and we'll work through a bunch of different problem sets, but most of it's geared towards current market opportunities. So that's what's coming up. As always, if you guys need anything, let me know. Be an outlier. See you guys later.